Hi everyone. Let's explore this customer loyalty problem. This relates to deferred revenue. So you see the situation in front of you. We've got the Rocky and Riley's Dog Treat Center. Okay? It's famous for its bacon-flavored protein biscuits. And here's how it works. After customers accumulate 10 points, they can use those points for $10 off their next purchase. So in other words, each point is worth $1. And at the end of 2018, the company had sales of $700,000. It issued 40,000 points, and 20% of them were redeemed during the year. Okay? The company's recent history also revealed that 30% of the issued points would never be redeemed. Okay, so the question at hand is, how much revenue do we record? Well, let's first take a look at how the cash register system will most likely work. Okay, so most likely throughout the year, these entries are going to be made coming from the cash register system or whatever other system that the company is using to record its sales transactions. It's going to show a debit to accounts receivables of cash for $700,000 and a credit to sales revenue. And then throughout the year, it's going to capture that a discount took place. Now, I'm going to assume they're just reducing the sales revenue account directly, but certainly the company could be using some kind of contra revenue account, or even using a deferred revenue account if it's adjusting at year end properly. But for our purposes, I'm going to assume the cash register system is going to increase sales every time we make a sale, and then decrease sales every time a reward takes place. So how did I come up with the 8,000? Well, I took the 40,000 points times 20% times $1 each. All right, so my question down here is, couldn't this be what the company does and we're done? Well, the answer is no. And the reason why the answer is no is because this would not follow proper accrual accounting, right? Accrual accounting says we record revenue when it's earned, and then we match the expenses to it. Well, we would be recording $8,000 too much of revenue, since there was a motivation of these employees to take advantage of the points, or at least historically we see that there's a motivation occurring with 70% of them. So as a result, 700,000 of revenue, recording that and then just recording the amount that was reduced would be incorrect, because we are expecting that some of this revenue is going to lead to future redemptions. So we want to correctly record the amount of revenue in 2018. So what that means is we have another entry we have to make. Okay, now here's the entry. At the end of the year, we're going to make an adjusting entry. Okay, we're going to make it for 20,000. How did I come up with that? Let me hit the F2. Of course, I'm doing this in Excel. So what I'm going to take is the 40,000 full year points times 100% minus 30%, or 1 minus the percent that we think will never be redeemed. Now, if we only did that, 40,000 times 1 minus 30%, and then multiplied that times $1, that would tell us how much we expect forever of the 40,000 points we issued that we expect to be redeemed. But since 8,000 was already redeemed, we know that the balance is what else needs to be redeemed. So I'm then going to subtract what I've put in cell G19, that 8,000 that we've already considered because they've already been redeemed. Now, technically, that formula should go here because we're really calculating the deferred revenue amount, right? Really, that's where that formula should go. Okay? And then this sales revenue should follow it. But when you think about it, you're trying to calculate how much do we need in the deferred revenue account at the end of the year. Okay, I hope you found this to be helpful.